Hey, what's going on, everyone? Colin here from moremoneymaintenance.com, and welcome back. This video is going to be split up into two parts today. Originally, I was intending to do just an informal Q&A session to address some questions that I asked for on social media. I reached out and said, hey, does anybody have any questions? And I got a few good ones, so I just wanted to answer those and give my perspective and opinion on how I would handle the situation. But before I get to that, I just want to explain a paradoxical issue that I realize I've been facing for a little over a year now, and I'm curious about how I should go forward in handling it. I'm not sure if anybody will have any input on it or if they have a perspective, but if they do, let me know in the comments below. So the issue that I'm talking about here is the issue of the algorithms that run our digital world. We all know that there's algorithms that help tailor the content that we see to make sure that we're enjoying the platform. So if we're into travel or music or fashion or sports, that's the content that we're probably going to get advertisements for, and that's probably going to be most in our feed because those are the pages that we're going to follow organically. And then because we follow those pages organically, that's the content that's going to be recommended to us by Instagram, Facebook, YouTube. Whatever we're following on our own accord is the stuff that gets recommended to us. Now, myself and most other financial literacy advocates, we've taken the social media to spread the message. And the consequence of this is that we've all been getting tailored towards or recommended towards each other's stuff, which is good. We're all learning from each other. But it's not as often that our message gets to the intended audience, which are those that don't have a financial foundation. The whole reason why there is a financial literacy community is to help educate those and to help teach those that don't know where to begin. But those who don't know where to begin typically don't know how to begin, so they're not looking us up. They're not looking up. They don't even know what questions to ask. And without asking the right questions, they're never going to get the right answers. And so, obviously, social media is not necessarily intended always to be a place of education. It's often, and its purpose originally was for entertainment. But with there being a gap in what's being taught in the school system, I would argue that the message has to be shared somewhere. And YouTube is a great platform. I would see why Instagram might not be the place to go to learn about finance, but YouTube in itself is a really good platform. But the same rules still apply here. If you're not actively seeking financial literacy content, it's often not going to just show up in your feed. So how do we get the message to those who actually need it? Because I'd argue that the wealth gap is only going to be exacerbated if something doesn't change. Because we're going to have a whole new generation of people that either have no idea what financial literacy is or know the ins and outs and base their everyday actions on that knowledge. And so those who understand it are going to at least try to make good financial decisions every step of the way. And those who have no idea are going to get left behind. Now, while social media has the power to democratize this information, the use of algorithms is really flipping it in the other way. I would argue it's almost essentially groupthink. It's all the stuff that you're interested in, you're going to get to see every day, and all the stuff you don't care about is going to be filtered out. And again, I understand the point. It's a good point. I understand that. I use Instagram to see what I want to see. If I follow financial literacy pages myself, I don't want to go and see travel show up. I want to see finance. That's what I'm interested in, and that's what I want to see. But I'm wondering what the line is. Where do we draw the line and try to provide the access to information to those who need it? Because if it continues down this path, those with the knowledge it's going to be a small community. It's going to be a very small and purposeful community that has all the knowledge about finance, and everybody else is going to get left behind. And to me, that's essentially what created the wealth gap that we know today. I mean, back even 15 years ago, learning how to invest, learning how to get into the markets was not easy. There was a lot more barriers to entry because we didn't have a digitalized solution. But once computers became a bigger thing and we found that digitalized solution, we found a lot of people seeking knowledge on their own accord in the beginning. A lot of people were interested in the topic and wanted to learn more. And then as information became easier to spread, people were sharing it with their friends. They were sharing what they learned, what they wanted to learn, ideas that were out there, some of it good, some of it bad, but it kept communication flowing. Now with I would argue, excessive use of algorithms, we're starting to see the information be so highly customized that unless it is your exact interest, you might not find it. And that does worry me. That concerns me that really we're going back down the same rabbit hole. So I'm very curious about what your thoughts are on the situation. Do you think that the algorithms should be as intense as they are today? Do you think that they serve a good purpose, that you want the information to be customized? Or do you think that it might be inhibiting the flow of information? Because I'm still not even 100% sure where I stand on it. I see the potential issue there, but I also see the good in it. I see why it serves its purpose because it benefits me every day. So let me know what your thoughts are in the comments below. And I have a feeling that this is going to be a topic that we circle back to at least a few times because I just don't think it ends here. I think there's even a lot more to it than I fully understand. So with that said, let's kind of get off of this and move more towards the Q&A session because this is the stuff that we do have control over. If you did stumble across this video, it's because you are trying to learn something. So let's get to the actual learning piece of it. Now, as we're going through this, I do want you to keep in mind that this is just my perspective on the situation as it was presented to me. And I say this not as like a liability catch-all, but as a fact of human nature. As unique individuals, we really do have different factors that impact the decisions that we make. Instead of taking my opinion and implementing it verbatim, try to take the logic behind it and my reasoning, what I use to make the decision, and just try to use that as your basis for the decisions that you make and put in your own nuances, put in your own life situations to customize it towards what you need to get done. So that really does just lead us to our first question, which is a question from Anthony. And Anthony asked, what are the ugliest truths about trading gurus? And I'll start with what I consider to be the worst. There's this relatively new trend of trying to create digital content or digital courses more specifically as a stream of passive income. And the issue with this is that instead of deriving from a place of wanting to teach somebody something, people get the idea of, let me create a course to make myself money. But then that leaves what's step two. And step two is, well, what can I teach? If I want to teach somebody something and I want to make money doing it, what is there out there that people are willing to pay to learn? And an honestly obvious answer to this is day trading. If people think that they can spend $30 on a course and that the return on investment will be several $100,000 simply because they become a stock market master, then it's a pretty easy audience to target. And because of that, it happens to be a place that a lot of these content creators go, or these people that want to make digital products. And what makes it worse is that because their step one was wanting to teach anything, it doesn't matter what it is, they just want to make money. That usually means they don't know what it is they're teaching. They're not an expert in the field. Their driving force was, I want to make money teaching something. And they figured out what that something was based off of who was willing to pay. And one of the ways that they were able to pull this off is actually one of the other ugly truths that I was going to talk about today, is that these people are almost never transparent. They're quick to drop screenshots of the trades that have gone well for them, but they rarely, if ever, drop evidence of the failed attempts. Since we don't follow these people around 24/7, we have no idea how good or how bad they are, since we're only getting to see the good. We are at the mercy of what they show us, and if they try to make any money being a guru, why would they ever show us the mistakes that they are making? Why would they ever show us when they are messing up? That would just be evidence for us not to buy their product or not to view their videos. So they don't show us that. They're trying to make money by exploiting people who want to learn. And the problem is, most of the people who want to learn trading are also looking for quick money, so they're more easily enticed by the flashy screenshots of big returns. This drive for instant gratification actually breaks one of the many natural laws of wealth by trying to receive unnatural returns in an unnatural amount of time. No matter how true we'd wish otherwise, there's no way to get rich quick without luck. And placing your financial future in the hands of luck is not a road that I would go down. And so personally, I would just try to stay away from anybody that's promising big numbers because the chances are they're not being genuine. And if you want to verify something, go back to Investopedia. Go back to edX, that platform where MIT and Harvard, they release free online courses to the general public. Go back to reputable resources to verify the information that you're hearing. And this way you know that the actions that you're taking are at least backed by some sort of fact, that it's not some guy just trying to sell something or just some guy trying to get a lot of views on a video that's not giving you the full picture. And so I wanted to thank you for reaching out with this question because I think it's important. I think a lot of people are faced with something like this, especially if they're new to investing. That's something that they're going to encounter. So I really appreciate you bringing this up and allowing me to talk about it. And if there's anything that you want me to dive into a little bit deeper, just let me know in the comments or send me a message and I'll do that next time. And with that, let's just jump over to our second question, which is from Alex, and has to do with the financial implications of moving away from home for the first time. So, more specifically, her question was, in this state of the housing market, would you buy or rent? What is the best financially? Now, the first thing that I want to do is provide some context behind the question. So, right now we're experiencing a heavy seller's market. And for those who don't know what that means, that really just means that a house that you're trying to buy today would have likely cost substantially less just a year and a half ago. But because so many people are trying to buy a house at the same time, it's driving prices up severely. And this isn't necessarily a bad thing, but it's definitely something to consider. So what Alex is asking is, does it make sense for me to buy a home right now when I could be paying more than it's intrinsically worth? And it's a good question to analyze. Now, the first thing that we have to realize is, why is this happening? The first thing to consider are the groups of people that left the cities because of COVID-19. There were people living in the city that felt that the close proximity of city living was putting them at a higher risk for the disease, or at a higher risk for transmitting the disease. And so they went to the suburbs where there was more space in between them and their neighbors and them and the people they work with. They just left to go to a place where there was more space. And on top of the people leaving the cities for COVID reasons, there are others that are leaving for work reasons. Many companies have adopted partial or full-time work from home policies as a result of COVID-19. They saw what it was like when they were mandated for everybody to work from home, and it was successful. For most companies, it was a successful initiative. First of all, it saves them a lot of money, but it keeps the employees happier because they don't have to worry about a commute. But if employees are going to be working from their home, they'd be a lot happier in a real home where there's space to move around as opposed to being cramped up in an apartment. So that also created demand for houses. And finally, there was a group of people that were ready to move but couldn't because there was a pandemic happening. So all of these forces happening at once caused a huge demand for houses with a limited supply, and this is causing the prices to rise. So clearly, it's a pretty complex situation. So I'm going to answer it in twice. Essentially, I'm going to answer it with how I'm actually handling it personally so that I'm not seeming like I'm giving advice that I don't actually follow. And then I'm going to give the advice based off of the parameters that were set, because that's really the only real way to answer the question. So first, let me give the context of myself. If you're going to ask me that same question of renting or buying at the moment, I'm going to say neither. And this is because in my current situation, I live at home with my parents and have since I started college, and now through the first year and a half of my career. See, I was lucky enough to experience life away from home when I was 18 because I joined the military. So when my initial training was complete and I returned back to my state, I decided to move back in with my family while I attended a local state university. Not only was it the financial decision that worked for me the best, but it was also my genuine preference after seeing what life was like a few hundred miles away from everybody for about 8 months. So I say neither because I'm currently doing neither. I'm not renting or trying to purchase a home. I plan to remain at home with my family until the dust settles with where the housing market stands, or until my job takes me elsewhere. And with that said, though, before the COVID-19 pandemic, my thoughts were a bit different. In the leading months before the lockdown, I was saving pretty substantially for a down payment on my first home. But when the pandemic hit and economic lockdown led to a major stock market correction, I had to make a decision. Do I keep saving cash for a home, or should I take advantage of the artificial lows of the stock market? It took me a few days to analyze the situation, but I tried to follow Warren Buffett's famous advice. Be fearful when others are greedy, and greedy when others are fearful. It was pretty obvious that almost everybody was extremely fearful at the time, including myself. So I decided to follow his advice and be greedy, while others were fearful. And by that I just mean I bought stock while everybody else was selling. The importance here is that Warren Buffett proved right. The money that was transferred within that market correction time frame has grown by anywhere between 25 and 60%, depending on which week it was transferred, all within less than a year. I emphasize this for two reasons. First, to outline how I personally processed the situation, but more importantly, it's to relate back to the original question. Warren Buffett's maxim seems to be correct more often than it's not. Think about the consequences of GameStop, the AMC hype, the Dogecoin hype, and the fear of last year's market correction. Even look back at the housing crisis of 2008. When excitement, which Warren Buffett refers to as greed, causes everybody to want the same thing at once, it often bursts, hurting a lot of people on the way down. But this isn't the only factor that you need to consider. If you're between buying or renting in the current housing market, the financial considerations vary based on your goals. Is this a long-term or a short-term decision? It sounds obvious, I know, that like obviously long-term and short-term decisions have to be weighed, but the consequences of a short-term decision in a hyperinflated market is a bit more detrimental. If you purchased a home right before the '08 housing crisis, there's a very real chance that it's still worth less today than what you paid for it. And in other words, if you tried to sell it, the amount that you would receive would not be enough to pay off the full mortgage, which means you'd have to either cover the rest of the mortgage out of pocket or just not be able to sell, or I guess declare bankruptcy. So if you're committing to staying in the exact same place for the next, let's just say 13 years, since that's how long it's been since the '08 crisis, it's my opinion that you'd be fine buying a house. It would be fine because everybody, even if you overpay, there's a chance for the market to correct itself and to come back full circle. But if you're trying to remain flexible and you may consider moving again within a few years, it may be better to rent, at least until you figure out what's going on. And while that does come with the real costs of that, the sunk cost, I guess we'll call it, where you're basically paying an expense instead of paying your own equity, it would still help you find housing that fits your needs while you wait for the dust to settle and figure out where you're trying to go. Now, the Fed has indicated several times that interest rates are going to remain low until well after the economy recovers, which many analysts speculate will not be until at least 2023. Those who think it could happen sooner are still speculating that it's going to be mid to late 2022, which still gives you a good bit of time. So if you're worried about the interest rates, it seems as though you're still going to have time where interest rates will be near zero. So as you can see, it really is hard to answer the question because of how many nuances are involved. I would say, though, that a lease is a lot less permanent than a mortgage. If you plan on buying a single-family home, keep in mind that we are seeing a housing market that has not been this strong since 2006, and we all know what happened next. Here's a clip from a Yahoo Finance interview with a Zillow economist that gives us thoughts.
But want to check something that we are paying attention to, and that has to do with real estate, because it's been a good year for a lot of people, especially if they were selling in certain locales. Jeff Tucker is Zillow economist. He's joining us now, and it's good to have you here. I don't want to say 2020 is a record year, but we haven't seen appreciation like this since what? Almost 14 years, 2006. Can we sustain it?
That's right. Yeah, the recent monthly price appreciation we've seen in the Zillow Home Value Index is the fastest since actually the peak pace of appreciation back in 2006. The annual appreciation looking back over 2020 was a little bit more modest, about 7.5%. But we expect this to be sustained well into 2021. There's a lot of pent-up demand from people who kept trying to buy homes and were stymied this year. Partially because they had sometimes had trouble finding a home for sale. There's about 1/3 fewer homes on the market at any point in time in the last few months. And they're still being driven by some of these fundamental factors of record low mortgage rates, well under 3% still. And just actually the fundamental forces of aging. There's a lot of people entering their 30s right now. There's about 3 million more people, about 23 million versus 20 million 10 years ago, who are in the key age range of 30 to 34. That's the age at which Americans tend to buy their first homes. And so they are really trying to come into the market. And I think a lot of them sort of accelerated that decision in part due to the pandemic.
As you saw, there's such demand for houses at the moment that it's greatly hindering the supply, driving the prices of what remains even higher. And according to Warren Buffett's maxim, this is being greedy when others are greedy if you're trying to buy something at the moment. So if you do plan to purchase a home still, it would still do you best to do very specific research on your area. Try to understand how the home prices have deviated from their natural norms in the last year and a half. Try to understand how that area was impacted by the '08 crisis, how long it took for them to recover from the '08 crisis, and how much it appreciated in the last year. If you understand all of these statistics and you're okay with them, or if you plan on this being your forever home, or at least a long-term investment, then you may have found a good opportunity with the low interest rates. But if you are finding that as of recently, the home values of the area that you're looking at have appreciated dramatically, or if you find out that you are going to settle down long-term somewhere else, it may be a good idea to rent for the time being, because this will still allow you that flexibility without locking anything in that could leave you underwater in a few years. So if I was in your position, those are the data sets and those were the key points that I would be looking into before I made my decision. So thank you for reaching out to me with the question. And I really hope that I provided some value. And if there's any other questions that you have about it, just let me know. Send me a message or drop it in the comments, and I'll address them the next time. So thank you. And for everybody watching, I planned on doing 3 questions today, but the 2 that I did were so nuanced and complicated that I'm just going to hold off the rest for another episode. So if this provided you any value, please let me know in the comments. Like the video, subscribe, and remember to hit the notification bell so you get notified the next time I put something out. And please remember to tune in next time to conduct some more money maintenance.